Doing okay. So lots going on as usual. And I want to tell folks about the event we have going on tomorrow. That's first thing in the morning. We are going to be meeting with the most requested speakers from the 2023 Rural Symposium in Boca Raton. And this is going to be simulcast on YouTube and LinkedIn. So if you haven't signed up for a reminder on that, please do so at the Rural Investment Media YouTube channel. If you're in the classroom, there is a link among the featured items. Rick, we got a lot of great CEOs joining us tomorrow. What are your thoughts?
Well, I think it's important for a lot of reasons, Albert. It was always, at least my vision, to have the symposiums and the boot camps, frankly, be coordinated with the rural classroom. The idea has always been to assist the investor attendees to equip them with the lessons in the classroom to apply in the symposiums and in the boot camp. And I think that this is the first example of our ability to cause this to occur. Teaching people to be better investors and allowing them to interact with CEOs of companies that have been vetted, I think is a wonderful way to do this. From a separate point of view, Albert, this is, I think, your effort and my effort to overcome the tyranny of time around the symposiums and the boot camps. If you are trying to teach somebody, as an example, everything that they need to know about uranium in 8 hours, it's impossible to do. You can present the material in 8 hours, but the attendee has to review that material, I would suggest, over 5 or 6 months, again and again and again. And in addition to that, they need then to apply the lessons that they learned. The format that we have coming up tomorrow gives people the ability to review the tapes from the symposium, review the lessons from the rural classroom, and then employ the lessons that they learned in real time. And I really think that this is the future, but not just of rural media, but rather of media-hosted interaction between investors and investment opportunity. So I'm very excited about it.
If you're new to the classroom environment, you can log on. This is a free membership you can get at ruralclassroom.com. And we have posted the breakout sessions from the speakers that you're going to hear from tomorrow on the live stream. So if you want to do some homework ahead of time, you can go in there and watch those breakout sessions, have your questions ready, and then ask them tomorrow when we bring the speakers on. I was just reviewing Benoit LaSalle's presentation in Boca Raton. And the first thing that jumps out at you, apart from the man's general, charisma and likability, is in terms of one of the key things that we talk about in mining, which is jurisdiction. He seems to have experienced both extremes of the spectrum in Africa. He talks about a horrible result in one of his first project, and now he calls Morocco the best jurisdiction in the world. Rick, what are your thoughts on Morocco as a mining jurisdiction? Is it as good as he says?
Well, I have to say that Benoit's a good promoter, so he's probably talking his own book. But the truth is that he hails from and has material support from the political establishment in Quebec, which is reputed to be one of the best mining jurisdictions in the world. The fact that he leaves his home in Quebec and he leaves the overt political backing of what I laughingly call Quebec Inc., the Caisse du Pot Populaire, and goes to Morocco, tells you a lot about that destination from the point of view of prospectivity and ease of doing business. It's worthy to note that Benoit has operated throughout Africa for a long time and has dealt with many circumstances that other people would find risky. I think it's partially a testimony to Mr. LaSalle and his team, and I'm not trying to be politically correct, but their skills with real cultural sensitivity, that they have been able to operate, of course, first in French Canada, in Quebec, but later all over West Africa, and now in a new country, Morocco, and operate successfully. So I think we have a lot to learn. I'm not discounting, by the way, Morocco as an investment destination. They're one of the biggest phosphate. They may be the biggest phosphate producer in the world. And I think from a geological point of view, they're an extension of the Iberian Pyrite Belt, which was, of course, as a copper, lead, zinc, silver belt, one of the great belts in world history. The European explorers didn't follow the belt across the Mediterranean particularly well, but obviously times have changed. And I'm delighted with the success that Benoit has experienced there, and delighted that he has received, from his viewpoint, such a warm welcome.
Okay. Another person I spoke with just now is Rudy Frank, founder of Seabridge. He's going to be joining us tomorrow. Also, Rick, a very popular speaker at the conference. He was, I think he was the second most requested person for this event we're having tomorrow. And I think part of it stems from the fact that sort of newbie, more financial focused people like me can understand his story, Rick. You don't need a lot of geological depth to understand what they're trying to do. So your thoughts on Rudy and Seabridge?
Yeah, first of all, Rudy is a very focused businessman. You will note in tomorrow's discussion that he's worked 25 years, 2.5 decades to become an overnight success. He and his backers came to believe a very long time ago that ultimately our collective financial sins would likely lead to a deterioration in purchasing power of the dollar and a revaluation, at least in nominal terms, of gold upwards. And they sought to get control of as much gold as they possibly could for as little money as they possibly could. And as a consequence of that, have beavered away for 25 years to put together the Kerr Sulphurets project, which in terms of reserves and resources is in excess of 100 million ounces of gold. The investment theme here is, as you suggest, very simple. At current gold prices, that deposit may not have very much value because it's low grade and an awful lot of capital is required to put it in production. But if the gold price increases meaningfully, this will be a must-own gold deposit. The major mining companies around the world struggle to and do not succeed in replacing their reserves. They must be aware of the fact that they are madly producing gold when the circumstances in place to let the gold price go higher. From the majors' point of view, it would be a pity if the gold price went higher and they had a hole in the ground where their gold used to be. If we do see $2,500 gold, or if we do see $3,000 gold, what Rudy has been trying to do will become enormously successful. It will be a must-own deposit. Rudy very correctly says that his company has neither the financing nor the expertise, frankly, to build a $7 billion gold mine. Their job is to de-risk the project as much as they can and hold on to as much of it as they can, and then either sell the company or, preferably from their point of view, sell an interest in the deposit to a major mining company that has the technical expertise and the financial wherewithal to make the trade. And a higher gold price is what's required to enable them to do that. As you suggest, this is a very, very, very simple project, or pardon me, subject. What I hope he gets around to talking about is the very concrete steps that he has taken to preserve his interest in the project. As an example, the very deep relationships that he has forged with the Tahltan First Nations, the indigenous hosts of the project. That is maybe less simple to understand, but I would suggest absolutely critical with regards to the ultimate success of the project. He has been very successful, too, in developing a constituency, an investor constituency around his company that bought into his vision and had the patience that was necessary to play the optionality game. So building the constituency to lower his cost of capital while simultaneously establishing and deepening relationships with his hosts, the traditional people, where the mine are some of the reasons why Rudy has been a success. And I hope that he delves fairly deeply into those less obvious benefits of investing in his company.
Yeah, and you'll be right beside me, Rick, teasing those details out of him. So I have no concern that
or beating them out of him, frankly, if that's what's required.
Yeah. One of the things that came out that Benoit stressed in his workshop was that people in this business, they have a challenge in that when they mine their resource, their assets are worth less. And so you have a company like Seabridge where they're not mining any of it, sort of carrying it all forward for what we believe will be a higher gold price later. Makes a lot of sense. Another group that's embraced a similar business model would be Amir Adnani at Gold Inc. With Scott Melby. Scott will be joining us tomorrow because it is actually the uranium side of their business that drew the most attention in Boca Raton. Similar to last year, Rick, uranium always popular these days, and we're lucky that Scott Melby is going to be joining us tomorrow to talk about his company.
I'm delighted that our audience is sophisticated enough to understand the benefit of uranium. With many of the commodities that I talk about a circumstance of when something comes true, when it passes into a bull market. We're in a stealth bull market in uranium right now. Most of the other industrial commodities have been fairly weak this year. The specter of recession, the specter of a Chinese slowdown, whatever, has caused in commodity after commodity after commodity price declines. Uranium, by contrast, has been up, and the price of the better uranium companies has done very well too. Cameco is an example. The easiest stock to buy of the group is at multi-year highs. And I'm struck too that Amir Adnani, despite his fairly young age, has also worked 2 decades to be an overnight success. Amir Adnani began his quest to establish a uranium hegemon in the last bull market. But unlike most people who participated in that uranium bull market, when the uranium bull market turned into a bear market, while most of his competitors decided to focus their efforts on gold or marijuana or crypto or some other area that they had no expertise, Amir spent the next 15 years buying uranium assets very, very, very cheaply. And he has done a wonderful job of backfilling value. Amir, like Rudy, has also done a great job of communicating to the investment community so that he has built a cadre, one would almost say a cult, of investors who buy into his contrarian methodology, the idea that you buy assets out of favor, you beneficiate them consistently, but you don't return them to production until your return on capital employed producing them is worth your while. He said very clearly when he shut down his uranium production that he wasn't going to produce and sell uranium at $35 or $40 when it was absolutely inevitable that he'd be selling it at $65 or higher. We're approaching that now. And so I think we have a lot to learn from this team about company building, about investing. And in Scott Melby, we have a guy in his early 60s that has literally spent his entire adult life in the uranium business. He was an important marketing executive for Kazatomprom, the biggest and, in my opinion, the best uranium company in the world, and also an important marketing person for Cameco, the dominant North American producer. So in this one spokesman, Scott Melby, we get to learn about the inner workings of an emerging American uranium hegemon, while at the same time availing ourselves, in a more general sense, of somebody who has 30 or 35 years of experience in a subject where many other people were incapable of spelling the subject, being uranium 5 or 6 years ago. Wonderful opportunity.
Yeah, and lots of encouraging feedback from attendees, Rick, on the floor, who just delighted in learning from Scott. Had several conversations with people who really appreciated his presence. And then the last issuer that we have participating is John Miniotis from AbraSilver. Kind of flew on the radar because I didn't see a talk from them at the conference, but they were present on the exhibit hall and impressed a lot of people, Rick. Again, one of the top rated sponsors from 2023.
Well, they have a very interesting discovery, and it speaks to the love affair that our audience has with silver. Silver, as you and I have remarked, Albert, most recently at the Silver Boot Camp, tends to move later in a precious metals bull market. But once it moves, once the momentum has been established by gold, silver tends to move much further and much faster than gold does. And as our mutual friend Doug Casey points out, the most volatile asset class in resources to the upside are the silver equities, simply because they're so rare. Most silver in the world, of course, is not produced from silver mines. It's produced as an adjunct, as a byproduct from lead zinc mines, from gold mines, from copper mines. Silver producers, people who produce from primary silver, are therefore more leveraged and very, very much more scarce. As Doug Casey teaches, when the narrative switches to silver, which happens about once a decade, and the generalist money comes into the silver patch, there isn't enough market cap to contain the money. The upside that you see in the silver equities, particularly the better small silver equities, could be very dramatic. And I think that our audience base, some of them have experienced as many cycles as I, which is to say they go back in the business to the 1970s. And they understand that while silver bull markets are very rare, they are also very special. I think the specter of silver and its upside being out of favor, meaning that the equities are relatively dormant and relatively cheap, and a new silver discovery and a relatively small market capitalization has met a sort of an irresistible combination for our speculator audience.
Right. I look forward to John's presence tomorrow. And then the final company, Rick, not a mining company, but one that has a lot of interest in the community, and especially among classroom folks. And that is Battle Bank. Battle Bank joining us again. Frank Trotter will be live with you answering questions. It must be, in a way, difficult because there's so much interest. People want to know more than anything else when we're getting started. That seems to be a common question. Regulations are what they are. What kinds of things can we talk to Frank about, maybe apart from the obvious that, when can I do business with you question?
Well, I think there's a lot to talk about. And by the way, the when, I think, is getting much closer. The holdup, as I understand it, and Frank might clear this up tomorrow, but as I understand it, has been slow and I would say confusing response from the FDIC. As the FDIC points out, the last 7 months have been challenging for them. While my application in front of them is the most important thing as far as I'm concerned that they have to do, things like the collapse of Silicon Valley Bank and First Republic Bank, from their point of view, were probably somewhat more interesting than my application. So while I resent the delay, I certainly understand it. We were not the only thing, or from their point of view, the most important thing on their docket. But I think that the subject of banking as an investor, but also as a human being, is a very, very important topic. I think the emergence of Battle Bank as what I would suggest is a sanity-based bank is at once an investment topic and a human topic. The idea that the regulators, as an example, consider a bank that has a 7% equity slice against their assets as being well capitalized is something that I think is a little strange. I think most banks need more, not less, equity capital. The idea that many investors, because of their fear of small banks, have concentrated their deposits among big banks who don't pay them any interest, means that many investors have consigned themselves to a position of guaranteed failure by taking the risk of depositing accompanied by no reward. The idea that with regards to the very big banks, the JP Morgan Chases, the Hong Kong Shanghais, the Bank of Americas, those banks, the idea that they can have nominal exposure to derivatives, in the case of some of these banks exceeding $50 trillion, with a $350 or $400 billion asset slice strikes me as very strange. I will admit to you, Albert, right away that the guys who run those big banks are much smarter than me. But I don't think that they're smart enough to run nominal $50 trillion liabilities with a $400 billion equity slice, particularly when that equity slice is meant to guarantee the depositors versus the lenders. Further, I think it's worth discussing whether any group of bankers in the world is smart enough to understand 500 or 600 businesses. There are a lot of banks that lend to 200 or 300 industries. And I think it's impossible that they can have the depth of experience that would be required to understand the collateral that they're lending against or the business prospects of the people that they are lending to. I think those are all wonderful discussions. I think it's worth discussing, too, whether it's practical for Americans or citizens, frankly, of any other country to have all of their savings denominated in one currency. Battle Bank, like every bank before it, will have money market accounts and CDs available in 20 or 22 currencies, which I think is a much more prudent way to save. And as lenders, Battle Bank is going to do things that it understands, like lend against physical precious metals as collateral. I can't imagine better collateral than physical precious metals. Liquid, easy to control, easy to value. So I think that's very attractive. Another thing, Albert, that just absolutely amazes me, and some of our viewers may have understood this, but it turns out that there is an unpublicized feature of certain IRAs that I never knew existed, which is to say checkbook IRAs, where your IRA can own an LLC, and that LLC can own, as an example, owner-operated rental residential real estate, single-family homes, duplexes, triplexes, fourplexes, private equity, private businesses. It never occurred to me that I could legally have control of my own IRA. So the idea, and by the way, this is completely legal. When Frank told me that Battle Bank was going to do this, I sort of said, Frank, you're going to go to jail. I'm not. I don't want to hear. I don't want to know. And he calmed me down enough that Battle Bank's lawyers talked to my lawyers, and they said to me, this is in fact true. This is an asset class. The idea, I mean, the whole idea behind Battle Bank is that your money is your money. If you deposit it, you should be paid competitive interest rates. If you want to save outside the US dollar, you should be able to do that. We propose to lend money to deserving borrowers against collateral that we understand. But we definitely believe that your money is yours, whether it be in a deposit or in one of these passbook IRAs. So I'm very excited about that discussion tomorrow. And it was heartening to me, not just because I'm an owner of Battle Bank. It was heartening to me because this is an interest I'm deeply passionate about, to see the interest that Battle Bank generated on the floor of the conference.
Oh, yeah. Lots of interest. And I've been familiar with these IRAs for a while. It's a boutique industry, Rick, administering these. And I think maybe credit is due to maybe the real estate investors, small real estate investors and gold investors who maybe provided the market for this. I'm not sure. But I've known about these for quite a while, and they are perfectly legit. They're not as useful as you think if you were hoping to benefit directly from the assets in the IRA, but you certainly can manage them as part of your asset allocation. So we have some people here in the chat room. If you have a question for Rick, please just type it in, or we're happy to invite you on screen if you are camera ready. Rick, I want to talk about maybe some stuff going on, but before we go to the news, maybe there's some news in the resource industry you want to cover. I want to ask you a question about the foreign currency CDs. How difficult are these to offer? Because this is something that EverBank offered in the past. You don't see this from other providers, though. And I'm wondering if they don't have the market, they don't have the vision, or if there are some administrative, regulatory, or technical barrier to offering, CD denominated in euros or yen or Canadian dollars, which were all things that EverBank offered in the past.
I think there are three problems around them for other institutions. The first is that the market is, from their point of view, fairly small. Bank of America, JP Morgan Chase, RBC, all offer this product in $1 million slices. They don't offer it in $5,000 or $10,000 slices. For Everbank, this was an $8 billion business. For Bank of America, the credit spread on $8 billion probably wasn't enough money to amortize their carpet costs in head office. But for Everbank, it was a feast, and for Battle Bank, it will be a feast too. A second problem, which might be more germane to the big banks than the first, is that at Everbank, if you were, let's say, a Canadian business person doing business on both sides of the border, and you needed to make fairly common transfers between Canadian dollars and US dollars, at Everbank, that currency transaction between your own accounts could be accomplished very inexpensively. I know from experience at HSBC and at Royal Bank, they'll do that transaction, but they'll charge me a lot of money for it. So offering that feature to high net worth customers tended to cannibalize the bank's own FX business.
Right.
And one could understand why, as an example, the Royal Bank, the largest foreign exchange trader in Canada, found it so difficult when you and I were at Sprott to effect efficient currency transactions. The reason was because they were efficient, and efficient wasn't in their interest. Inefficient was in their interest. And so, I think that's a problem. Constructing them really isn't particularly difficult. It just isn't difficult. But I think the size of the potential asset class. I also think, those big financial supermarkets, Albert, I'm tempted to say that they aren't particularly adept at meeting customer needs. I noticed that the big bank, and I won't name it, that I bank at, has at last count 15 savings products. When I went to my branch about 3 months ago, I'd had a liquidity event and I was looking at savings products at this bank, and my branch manager didn't know very much about her own products. She had so many things to do, I guess, running the bank, that she was forced to point me to a white service phone. I guess forwarded me to India so that somebody could explain these 15 savings products. By the way, of 15 savings products, one of the features common to 5 was that they were prepared to pay me no interest on my savings. You can imagine how interested I was in that proposition.
Yeah. I've noticed that going into banks more recently, I haven't done that for a while, but more recently I have. I noticed one thing sort of universally true among the staff is that they're not as attuned to the product offering or how things work, but they're all hyper empathetic. And I think their main function there is to provide that I guess the comfort one needs when dealing with a big bank these days, where you feel like you are not seen or treated as a human being. You go into a branch and you're absolutely treated like a human being by someone who's very good at doing that, but they don't necessarily understand or grasp the entire product offering or what you're trying to do.
I will say that the branch manager at the branch that I go to is very good at serving tea and cookies. But I don't need to go to a branch for tea and cookies. I can do tea and cookies at home. And the tea comes up in a way I like it. And, Albert, the customer pays the cost of a branch. Branches add between 110 and 125 basis points in non-interest expense. That comes out of your deposit. I think that maybe we could say in a very broad sense that the banking business is at least bifurcating in terms of their ability to serve individuals. There are some that require that require a branch, that require that human contact, even if the human contact can't give them very much information about the products. There are other customers like yourself for whom this can be the branch. If your phone is my branch, I save that 125 basis points and I can pass it on to you. That requires a certain level of sophistication. If you go back to Everbank, the predecessor to Battle Bank, as I recall, the average deposit balance among the customers was about $100,000. That doesn't mean that they didn't have some that had less or substantially less there. But what it meant was, relative to the length and breadth of depositors in the United States, the EverBank customers were fairly well-heeled and fairly sophisticated too, which is why it was so profitable to bank them. And I think that Battle Bank will have that same advantage. And I don't think that as a subject, Battle Bank is unique. I think that a market like the U.S. needs a more variegated response in terms both of lending and in terms of deposit products. I don't think that we will be the last of the innovators in the space. I recently looked at a survey published by one of the banking organizations about the best performing community banks in the United States. And I was struck by both regional and product depth. There's one particular bank in Austin, Texas. I forget the name of it. One giveaway was that it was Indian, meaning East Indian, owned and operated. The other was that they focused on hospitality. What could be more natural than a bank run by Patels, accepting deposits from Patels and lending money to Patels who are taking over, who are taking over the hotel and motel industry in the United States. It's absolutely a wonderful thing for the depositors, for the borrowers, and for the country. I think it's spectacular.
Okay, let's move on to the news, Rick. What are you following these days? I know you post a lot on LinkedIn and other places, commenting on stories. What jumps out at you?
Well, I think one thing that we talked about earlier today, which is to say the stealth uranium bull market, a whole bunch of comments there. The uranium price at spot has, of course, increased from $25 to $55 or $56. But that misses the big story. The big story is that 3 or 4 years ago, 85% of the transactions took place in the spot market. Now, between 75 and 80% of the transactions are taking place in the term market. The term market is much more opaque than the spot market, which is to say you can't see it and you can't understand the nature of the transactions. But it would appear that most of the transactions are taking place above and substantially above spot, and most of them are indexed with contractual minimums and contractual maximums, but at escalating ratchets. This is important because the stability, the pricing stability that this gives emerging producers and established producers means that some of the mothballed production and some production that hasn't yet come into production can be financed. That's very important.
What are the terms? What's the how far out?
There are some contracts being signed apparently that have 15-year-long provisions.
Wow.
Which I think is very common.
It's a big
much
difference
more
from spot.
Yeah, much. That's right. And the pricing stability that it offers. If you look at the perturbations of the spot market going back 20 years, it's absolutely dizzying. And I can understand as a banker that where you are that unsure as to the price that your customer is going to get for the product, that you are very leery to provide long-term financing. The durability, not the durability, the predictability of pricing in the term market, particularly depending on who the taker is. But as an example, a contractual term from Duke Power, an investment grade taker, would make me much more calm as a lender. And I think, too, it would make intelligent shareholders of producing companies much more confident.
And I was just going to ask that, Rick. In general, the credit worthiness of the takers, is it pretty high, given that they're, I guess they're utilities, they have taxing authority, or?
It really depends on who the taker is. Increasingly, the takers are non-U.S. I think it would be interesting to try to enforce a take or pay provision against China General Nuclear in their own courts. Go up to Mr. Xi and say, well, sir, by contract, you owe me $500 million. May I have it? I think that would be an interesting discussion. But the truth is that I grew up in the U.S. natural gas industry, and I remember having some take or pay contracts myself in 1982 when the gas prices collapsed. And I remember one very prominent Middle South utility, the purchasing agent saying to me, now, Mr. Rue, we ain't taking and we ain't paying. So I'm not sure that concern necessarily is limited. So I look at the uranium business as one where what the term market does is it takes out that part of the imminent versus inevitable discussion around imminent. I think the fact that the market in terms has firmed up and firmed up concurrently with the pace of Japanese restarts, meaning it's underpinned by real demand growth, means that the uranium bull market that we've talked about for so many years as being inevitable is no longer just inevitable, but rather inevitable and imminent. I think that's very important. And I think it's a story that isn't broadly understood in investment markets generally, or in resource markets particularly. I think another theme that people need to pay attention to is all of the discussion about the BRICS currency. Yesterday, it was announced that 4 or 5 more countries have joined in the BRICS, and there's a lot of alarmist stuff about the fact that the BRICS control 80% of the world's oil. They did the day before yesterday, too. So the announcement yesterday doesn't change very much. I think you look at the BRICS for what it is, which is to say a settlement mechanism between parties who don't trust each other, not a common currency. The idea that the Russians and the Chinese and the Iranians and the Argentinians and the Brazilians and the South Africans and the Saudis and the UAE would subsume their domestic fiscal regimes and their currency to a common currency is silly. I also don't think that there is enough gold on the planet to back a currency that had that many transactions taking place in it. What you are seeing is the emergence of an alternative settlement mechanism. These countries have looked at the perniciousness of the United States. They have looked at the monetization of the settlements business, including SWIFT, and they have looked too at the debasement of US dollar denominated savings products like the 10-year Treasury and the 30-year Treasury. And they've said to each other, we have no second choice but to establish a settlement mechanism that is less dependent on the US dollar. Because they don't trust each other, because the Chinese don't necessarily want rupiah or rubles, and they certainly don't want Argentine pesos. The settlement mechanism that they are effecting is gold. Now, talking about it and doing it will be very interesting. In order for this to be a true settlement mechanism, the gold will have to reside somewhere. Imagine, as an example, that Russia ran a $2 billion trade deficit with China. And imagine Mr. Xi showing up with a bunch of bricks and presenting them for settlement with Mr. Putin. And Mr. Putin saying, well, no, those are debits, but I'm not actually going to give you my gold. What that means is that these countries will have to, in order for the settlement mechanism to be reliable and trustworthy, give up control of their gold. The gold will have to be on deposit somewhere where it can be wheeled from the Chinese vault to the Russian vault, from the Argentine vault to the Saudi vault. And Albert, I can tell you, going back to the early part of the last decade, when I was marketing Sprott investment products to the biggest sovereign wealth funds in the world, that as little as those countries trusted the United States for deserved reasons, they trusted each other less. I'm reminded of a wonderful quote by our friend Doug Casey, who said the US dollar is an IOU nothing. The euro is a who owes you nothing. And the BRICS will likely become a nobody owes you anything. At best, it's going to be a settlement mechanism. And I think people need to understand that. There are people on the gold side who suggest that having a, quote, currency backed in gold will lead to amazing demand for gold. When they hear my objection that there isn't enough gold in the world to back up their transactions, their response very quickly and with delight is, not at this price, at a higher price. I suspect that those gold bugs who are looking at the BRICS and the BRICS settlement system to prop up the price of gold need to look elsewhere.
Yeah, I agree with you on all points, Rick. I think the goal was to facilitate unobstructed trade, bilateral and multilateral, among a new group. And you see it happening right now. They're happy to trade amongst themselves, but when India takes so much energy from Russia that they have unusable rupees,
Yes.
More rupees than they have demand for Indian goods, it presents a problem. But everyone in that group trades quite a bit with China. I think China is the number one. I don't know about the additional 6, but certainly the original 5, those 4 countries, they trade more with China than they trade with each other.
You make a good point. I think the possibility exists for Chinese hegemony among the BRICS, which I don't think will be well regarded, particularly by Russia and India, who have historical enmity towards China. I think from Russia and India's point of view, what it probably is insurance against the United States. I'm amused by the inclusion of Argentina and South Africa, 2 total wrecks.
Yeah, but this is sort of a hint at how they're trying to democratize. You know, the problem, the alleged problem with G7 and these sort of Western originated entities is the inclusion, the lack of inclusion. So you can see Argentina being a concession to Brazil. You can see Ethiopia being a concession to South Africa, not really necessarily making sense from the economics of it, like Saudi Arabia obviously makes sense. But concessions along the lines to avoid the hegemony problem that you allude to, because there's no point in creating yet another institution that doesn't represent. It's very interesting.
The point of this for U.S. investors, and I suspect most of our viewers are U.S. investors, is that it is a blow to U.S. hegemony. I think, too, that U.S. investors need to understand that the enemies of the dollar are not in Beijing or Moscow or Delhi. They're in Washington. And the idea that our own actions are limiting our access to the exorbitant privilege of printing our own currency and exporting our problems. I remember Nixon's Treasury Secretary, John Connolly, described the US dollar as our currency, your problem. I think that 50 years of the US abusing its exorbitant privilege means that in the course of my lifetime, while the privilege won't go away, I think that the US dollar will still be the world's primary reserve currency for the balance of my life. For the record, I'm 70. I think that the degree to which we're able to benefit from that privilege will decline fairly substantially. And I think that that's a pity from the point of view of all Americans, albeit less of a pity for people who live other places.
Rick, can you elaborate on that comment you made at the outset? And that is the addition of these new members, particularly Saudi Arabia, though, didn't add to sort of the aggregate energy controlled by the bloc. You kind of lost me on that one.
Well, simply put, the fact that these countries became BRICS members yesterday doesn't change much around the energy market. The Saudis are still going to sell their oil.
Will it be in dollars or something else, though?
I think in the near term, if BRICS comes to pass, that trade balances will be settled in gold rather than US dollars. I'm relatively certain, as you point out, that there's a limit to the number of Argentine pesos, as an example, that the Saudis would like to control. Attempts by Argentina to impose hegemony on the rest of the world have been fairly halting, given the nature of Argentine defaults and their real skill at debasing their currency. I still believe that most trade in oil, including most trade in oil between BRICS countries, will take place in US dollars.
For how long?
For a long time.
Really?
I do think that the Saudis, at least the Saudi crown, is rather sick of being told what to do by the US government. I think the extraterritorial imposition of US politics and US social norms has been offensive to everyone. I think the second thing, Albert, that we need to view is the other cause of this, which is to say the lousy arithmetic around US dollar denominated savings products. I remember myself being in an East Asian country that shall remain nameless, and saying to my counterparty at the Sovereign Wealth Fund, when I learned that their Sovereign Wealth Fund had $3 trillion in US treasuries in it, I remember saying to my counterpart, from my point of view as a US citizen, this is a wonderful trade. You guys send us computers and ships and chemicals and cars, and we send you back pieces of paper with dreams painted on them. It seems to me, too, that the interest that we're paying you is probably nominal at best relative to depreciation and purchasing power. And I said, what would you say to the concept that the U.S. Treasury as a savings mechanism is a lie? And my counterpart looked at me and he smiled and he says, yes, Mr. Rule, what you say is true. But yours is a deep and liquid lie, unlike the lie that other people tell us. And then I said, do you trust us? And he says, oh, no, but we trust you much more than we trust each other. I think we're to the point now, 15 years hence, where a U.S. 10-year Treasury, as an example, paying 4 in a currency that at least I believe on a measurable basis is losing 7% of its purchasing power compounded, notwithstanding that fabrication called the CPI, has meant that the lack of a real interest rate payment combined with extraterritorial attempts to impose U.S. hegemony has meant that many countries see themselves as having no choice but to create a less optimal alternative.
Rick, I've heard this story before from you, so I know that this is probably at least 5 years ago. And I'm wondering if that person looking at the situation now, would they view the sanctions on Russia and the freezing and actually seizing in some cases of Russian central bank assets as a technical default?
A technical default. I don't know if they'd view it as a technical default, but I think that they might regard it, well, this particular country is very friendly with the United States, so I wouldn't believe that they would feel directly threatened by it. Other countries, which are creditors to the United States, say the Saudis or the UAE, might feel differently.
Yeah. Okay. We're winding down to the end here, Rick. I got to let you go in a couple of minutes. If there's a quick question from the audience, please put it in the chat. Otherwise, Rick, any final thoughts before we shut down for today?
Well, I really hope, Albert, that the people tuning in today will tune in tomorrow. I hope, more importantly, that people who have the opportunity to will avail themselves to the full range of educational opportunity that they get through Rule Investment Media. The third-party interviews conducted by yourself and myself, the live conference in Boca Raton, and the one coming up next year in Boca Raton, and the boot camps. And I hope that they do this in an integrated fashion. I hope, as an example, that every single person listening to this reviews the Rule Classroom course on interrogating mining companies, and that they use the lessons, in that classroom series in their own investigation of mining companies, both live ones, like we'll have the opportunity to do today, but also as pre-wear for future conferences and future boot camps. I think the idea, Albert, that we, before our virtual or live events, introduce our audience to our presenters will give the audience a better chance to prepare themselves to use the time at the event better. And I think, too, our continuing emphasis on after event or post-wear, where after the event we reintroduce exhibitors to our attendees, will give the attendees the ability to use the lessons that we've taught freely elsewhere on the platform to get maximum benefit out of interaction with the exhibitors and the events. So I'm very excited about this initiative.
All right. Thank you very much, Rick. So that's it for today. Hope to see you all tomorrow. That would be Saturday, the 26th at 7 a.m. Pacific time. Check out ruralclassroom.com if you want to watch the breakout sessions from the speakers we're going to have tomorrow. Lots of good stuff there. And I look forward to seeing you tomorrow, Rick. Thank you very much.
Thank you for setting this up, Albert. I appreciate it.